All right, so we're back now to our chart and see what the market is doing. This will give the market 2 hours. And right now, this was where we analyzed and stopped. Of course, we have been talking about selling the market because the correction has not ended. Now, this is the fourth candle. Remember, we didn't see any reason to enter on the second candle because of we did not see an engulfing bearish candle. So we expected to enter on the third candle. Then we also had a reason to wait for the fourth candle entry. Now, what are the conditions we're looking at here? The first condition is third candle entry, where the market makes a complete string from the second candle, and then third candle, which is the normal entry. Most people wait for the third candle to close, because sometimes since it's the entry candle, it might close bullish. So you want to take your entry on the fourth candle, which will be nearer to the stop loss. But remember, we said that there are also the negative effect of waiting for the fourth candle, because that's your last entry candle. Now, that is exactly what we are observing right now. We are seeing gain of momentum on the fourth candle, and that is because the third candle closed as an impulse, and the impulse here being that it is a complete impulse, the fourth candle has gone far away from where you would want to take an entry, because it's far from the stop loss. So the stop loss becomes wider when waiting for the fourth candle. So it's always better to enter on the third candle. Then when you wait for the fourth candle, if this plays out as it did here, then you might really have to take that entry per chance, because while the impulse has begun and you miss the right entry on the third candle when it didn't go against the entry bias, you might not want to go in when it's already too far from your stop loss. So let's measure how much of stop loss would have been here to enter on the fourth candle. That's 1.2264, and the stop loss is at 1.2304. So you see that's over 40 pips of stop loss, and that's a very wide margin. So compared to if you had entered on the third candle, 1.2275, then you have the stop loss at 1.2304. So that's 30 pips stop loss. So 40 by 30, that's a difference of 10 pips here. But that matters especially if you are the traditional risk manager who sticks with 20 pips stop loss. So that would have been too wide for you to take. So once again, it's important to follow the entry rules. Now notice that because we are trading correction and we had already projected correction for the week, we didn't need to be carried away by the temporary bullish moves we saw here, because we are measuring what the expectation from the market is. Now see what is happening here on the fourth candle. This is market pressure, and this is showing you that the market had waited up until now to make this move. Now, if you had taken your entry at the first time you spotted the entry opportunity, like we looked at these three levels of entry here. We had one, that was the last entry level. Then we had this and that. Now you notice that if you had your entries here and you were holding your entries, since the stop loss did not get triggered, you will still be in this market up till now. And this is when the impulse for your entry is coming. So holding your entry all the way from here, the correct entry price 1.2282 down to 1.2232. Right now you are still in the market because the impulse just started for the first time, and your stop loss did not trigger despite all these moves here, you would have been seeing already 50 pips down where the market is currently at 1.2231. And remember, the finality of these moves to the downside, we are looking at it at 1.2184. So the market is getting closer to that. And right now it has made the lowest low for the week since it started the correction move, and the lowest low right now is at 1.2229. 1.2229. So this about 30 pips from the final price of correction, which is at 1.2184. Where we'll start looking for bullish entry is what I mean. So when trading the market faces, it is important to have a clear picture of what you expect of the market so that you don't get carried away by the minor change in direction or bias you see. So one or two times you see minor change in the bias is not enough reason why you change your bias. Always know the rules for the phases. And that is why in our trade fair, we focus on teaching the rules to the point where you can master the rules and apply them consciously without any fear, so that when you're trading based on the rules, you will not be deceived by the temporary change in the market direction at any given time. You also have a good reason why you are holding on to your position if you want to hold for swing, or if you are trading intraday, you will also know why you are still holding a position despite seeing all of this tweak happening in the market. You know that your bias remains bearish as it is for this week. So we have maintained our projection for the week, which was bearish from the first day of the week. We drew that bearish indication. In fact, we did that indication on the previous week when we saw the termination of the impulse. We did that entry projection for the week, and right now you can see the market is respecting our projection, and that shows you the power of our trading rules. So for now, there is no new entry for selling because the market has given us all the entries for sell. So if you had confidence, you would have taken your entry again. If you missed the first entry at 1.2284, 1.2282, the second entry would have been here. All of them were ticked, 1.2286. Then third entry would have been here, going back 1.2294. So, but market didn't get 1.2294. Rather, it got to these last two entries. But if you didn't want to follow these entries, then since there was an impulse, a bullish impulse, the entry rule states again that you wait for the termination of that impulse move, then you mark that exit line as the closing price of the termination candle, then also mark your stop loss level, which is above the high in a bearish termination, or below the low in a bullish termination. So in this case it was a bearish termination, so we set our slab above the high and measure 10 pips as a stop loss above that high. That will be the stop loss. So then the entry will now be, if the termination candle is not an engulfing candle that engulfs at least two candles in the previous impulse, then the entry will be on the third candle. Otherwise, if that was terminated by an engulfing candle that engulfed two or more candles, the entry will be on the second candle. So in this case, second candle criteria was not met. It was the third candle criteria that was met. So if you had entered on the third candle, that would have been a good entry. But we had fourth entry where you need to be cautious and enter on fourth entry candle. You would have expected that, oh, since the entry candles always go in the opposite direction of your bias, of your entry bias, then why not wait for the fourth candle? Now, this is the risk of waiting for the fourth candle. You might end up coming in late, though it's never too late because that's your last entry price. But notice that when the fourth candle formed, because this was already on an impulse, you see there was no risk at all. The market did not make any deviation from that entry projection or entry bias from the fourth candle. So what you need to learn and take note of is that once you have your rule, stick with your rule. If you are a fourth entry candle and trader, then always enter on the fourth entry candle. If you are a third entry candle trader, always enter on the third entry candle. The second entry candle is optional if there was no engulfing candle. So the best entries are first the third entry candle, then secondly the fourth entry candle. So after these two, there is nowhere else you are required to enter. So take note and trade safely. Welcome, as we hope to see you in all our monthly trade fair, fast trade fair. So one trade fair will give you motivation for another. I hope to see you take advantage of the fast trade fair. Welcome.